Okay, so welcome everyone to Enhancing the Accountant Bookkeeper Connection Series. Um, here's just a little bit about myself for those of you who don't know me. So I'm hosting this series for John and Bob from Kata. And here's just a little bit about myself. I'm the founder of Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. I'm the 2017 Intuit Firm of the Future runner-up. I am a certified professional bookkeeper through the IPBC. I am a member of the Intuit Trainer Writer Network. I am a 2017 Black Swan alumni, an advanced certified QBO Pro advisor, a certified desktop advisor through QB. I'm a volunteer mentor through Future Pro Canada with over 20 years of bookkeeping and income tax experience. And then so we've got Bob and Jonathan, who I've dealt with them for a number of years. Jonathan, obviously, a little bit longer than Bob, and they're absolutely great. Love the knowledge, love their collaboration, and love that they want to give back and help the bookkeeping community as well. So thank you very much for this, guys. So if you just want to share your screen and take it away then and introduce yourselves, that's great.
Well, thanks, Tanya, for a great introduction. I'm just going to pull up our slides here. I'm Jonathan Carter. I started Kata Accounting back in 2014. We've been growing steadily and slowly. I was very, very lucky to work with Bob. Bob has an extreme amount of knowledge and loves the technology and loves what we're doing in the cloud space, so it's a fantastic fit. And today we're going to be talking about accounting for income tax. Income tax, HST, payroll tax, these are the three most common areas where we see issues. It's almost, I would say, in 90% of the files we receive, these haven't been reconciled properly. So, just a quick recap of what we've been over. Period 13, the whole concept that once you've done your 12 months, there's still a bit of cleanup to do. And of course, this presentation today is where a big part of that extra work is going to come in at year end. So, Bob, do you want to go ahead?
Sure. Thanks, Jonathan, and welcome everyone. It's great to be here with you and talk about this exciting topic of income taxes. This is one of the more challenging accounts that accountants look at, and it's complicated because of the data sources. So we require data from several sources. We need to determine where tax-related entries have been processed in the books, and quite often they haven't been processed in the right place. A person can get a GST refund from Revenue Canada, and they will put it in the wrong account. They see the slip, they see the amount, they say, oh, it's from Revenue Canada, it must be income tax, so I'll put it in the income tax account. And that messes up the account balance both for the tax liability and for GST. So there's a bit of detective work involved in looking at the different sources and straightening up where the entries have gone and fix them up. The other complicating factor, well, there are probably more than the ones we've listed here, but we in the income tax liability account on the balance sheet, we can be tracking several open fiscal periods, fiscal years, all at the same time in the tax account. I've seen cases where we can have as many as 4 or 5 tax years open, partially because CRA may still be looking at a certain year, or there may have been disputes or a reassessment. So we will want to track the liability for that individual tax year, even if it's 3 or 4 years ago. We can't close that out. There still is either a liability or maybe a refund coming for that particular year. So if you think of your income tax liability account, you can kind of think of it in columns. And I'm going to go through an example before we finish here, just to show you kind of in a very simple example, how I would set up a worksheet to track this. We also have the balance sheet account versus the P&L account. And I think that might be on the next slide, Jonathan, thanks. So we have, as I said, a P&L account and a balance sheet account. Balance sheet account obviously is the liability, the receivable or payable. So if you think of that account on the balance sheet, what you're normally going to have running through that account are payments to CRA relating to a particular tax year, hopefully the current tax year, but it's not always. So could be installment payments, could be paying a balance due after the returns have been completed and you're paying off the final balance. So you've got the installment payments, and then you're going to have the liability for each fiscal year recorded through the balance sheet account. That will offset the payments year by year. And hopefully at the end, the balance all comes out to zero, and you can kind of stop tracking that particular year. But of course, it takes time to get to that point. On the income statement, and this is where we find a lot of mispostings. The income statement, if you think of it as a standalone financial statement, the tax number there at the bottom of the P&L should only be a tax provision, like a tax amount calculated based on the income for that particular period. Whatever period you're reporting on, usually a full fiscal year, but if it's a larger company, they may have monthly or quarterly reports. That P&L should be standalone. So you look at the income, the accountant should calculate the tax that relates to the income for that period, and then process that in the income tax account. What we find is that a lot of times installment payments will be posted to that P&L account, refunds will be posted there. It's understandable because the account is labeled income taxes, but an accountant will prefer that any of those type of transactions you post to the balance sheet account, and keep the income statement, income tax provision account clean, so that we can just make a tax provision, and that's kind of the technical term, provision. You're providing for income taxes on the income reported for that period. Clean, simple, straightforward. So if you're posting installment payments there, if you're posting refunds, whatever, into the income statement, you're messing up that account. Those installments relate to the current year, and we just want a simple tax calculation. So hopefully that kind of clears up. And now looking at the data that's required to account for income taxes, having said that about the balance sheet and the income statement, we have the annual tax provision. So by that I mean the amount that the accountant will calculate relating to the income for the period. You have the company posting of payments and any adjusting entries. And then you have sometimes CRA will grab money if you're owing something from one of your other accounts. We're going to see that in the example that we'll be looking at. So you kind of have to bring all this, you become a bit of a detective. You've got to bring all this data together and coalesce it and make it make sense, and put everything in the proper boxes. So on the next slide, thank you, Jonathan. We'll start taking a look at this analysis.
Sorry, I went a little crazy there. I'll go back to the correct slide.
Yeah, I didn't think this. I thought I talk a little bit about the steps in accounting for income taxes, the way I look at it. So the first thing you want to do is look in your client.
Sorry, did you want slide 8?
Yeah, just the next one, please.
Sorry.
Did your key stuck?
There's a feature with Blue Jeans where if you hit the space bar to talk,
Yeah.
when you're on mute, but when you hit the space bar, it advances the slides really fast, apparently.
We're almost finished with the presentation then.
All right, this is the slide you want, right, Bob?
Yeah, that's great. So the steps that I normally go through, you first want to pick out all the tax-related entries that have been processed into the client accounts. And sometimes those are hidden in funny places. You may have income tax payments and so on posted in the GST account or the payroll liability account. Sometimes you'll find some entries put into interest expense if there's interest processed on an assessment notice or interest paid to CRA. So you dig out all those entries and now, so you're going to next check CRA records. So you go into this client's account with the CRA, look at what CRA has recognized, and quite often that won't match, as we'll see. So then you reconcile what you've seen in the client's records to what CRA is processing. Make any necessary adjusting entries, move funds around to proper accounts, pick up any entries that CRA has processed that aren't in the client accounts. And the last step is to look at the income for the current period, work out a tax provision, go through a calculation, and sometimes we just do the income tax return. We just go through the return itself and calculate the tax amount that relates to the current year's income. And we book that nice, simple, clean entry. We debit the income tax provision account on the bottom of the P&L and credit the tax liability account, assuming that the client owes money. Sometimes there's a refund, they've overpaid, and we put the entry through opposite. So that's step 5. Sometimes is challenging because you have to calculate the tax provision, but the entries for that are really clean, like 2-line entry. Okay, so I think we can get into the example. And I took this from, hey, I like that little guy turning around. So this is an actual client that we recently did the work for. And so what I'm starting out here in the preliminary books column, that's actually what was in the client's books, in the income tax liability account on the balance sheet. So the previous year, we had a liability of almost $3,000. In November, and I think this was a summer year-end client. So November 1st, they paid an estimated amount. You can see it didn't match the liability, which is okay. These amounts, the liability was probably set up just on an estimated basis. So November, they paid it. And then the other transaction, in March, there was a GST refund. And I found that out by looking into it and checking the documentation and so on. And mistakenly, it was processed into the income tax liability account. So if they're paying their GST based on the balance in their GST liability account, this $808 refund should have been processed to that account. So their GST amount is wrong and their income tax liability is also wrong. So that's what we started with. That was what was in the client's books. Okay, Jonathan, we can take the next step. So in order to keep the income tax account straight, and believe me, this can get complicated almost beyond belief. I've worked on clients, as I said, with 3 or 4 tax years outstanding. You've just got payments going into the account, so you have to work out which tax year they relate to. So you want to put into columns, both in your thinking and in your documentation, the status of each individual tax year that's open. If the client has gotten a final assessment and paid off the exact balance and CRA is happy with a certain tax year, then you can close that off and remove it from this analysis. But as long as you haven't got a final assessment notice, you'll want to keep it on this sheet. So what I did over on the right-hand side, there are the preliminary entries that were in the books. You bring that across and stratify it by year. So in this case, I noticed on the CRA site that they had an assessment notice for the 274416. So I put that in the 2016 column. And that's why the client paid that amount, 274416. And then the GST refund, we still plug that, I plugged it into the 2016 year. Just saying a little bit about the column you notice there, the free reserve. That's a technique that we use because income taxes, you're working on estimates, preliminary estimates, and then finalizing the number. So you're going to have things going into the account that are rounded, or they're not precise amounts. They're not precise until you get an assessment notice and you know exactly how much CRA thinks you're owing. So what we used to do, and it's a technique that works quite well, we would usually estimate a little bit high on the tax provision, and then when we came to pay it, that little bit extra would go into the free reserve. It's kind of like a balancing column. And what we like to do, because you're working with estimates a lot, like if you think of an accountant reporting on a year-end set of financial statements, you haven't done the tax returns yet, you've calculated an estimate of the income tax, so you'll probably round that up a little bit just to be a little conservative. And then when the final number is settled, you can move that extra liability into the free reserve column. So it's like a rounding thing based on estimating rather than having actual numbers and so on. And we always like to see that in a credit position. We always like to show on the books maybe a little more of a liability than you think the client actually owes. But of course you want it to be materially correct. So you don't want to have that column growing too large. So this is starting to put the numbers into the proper columns and so on, and understand what's going through the account. So in the next slide, we're going to start to clean this up based on CRA records. So you go into CRA, and if you don't know how to do that, that's subject for another discussion. But you have access to the transactions that have been processed for the client with CRA. Yeah, this was a July year end. So CRA has a nice rolling summary of everything that they've processed. So you can see there was a reassessment for a little over $3,000 our estimate was 2,700, so that was the amount paid. So now you've seen that payment in the client's books. Now you can match it to what's on CRA records. Yay! That's when you start to really jump up and down, and you're starting to reconcile between the two accounts. You can see CRA processed a little bit of arrears interest, and then they transferred $428 from RT0001. That's the GST account for the client. So CRA has done something that the client is probably not aware of. There was a refund relative to GST, but CRA has moved that to balance off the income tax account. So now you've got to pick that up in your analysis and understanding of the company's income tax position. So we'll get to the next slide and see how we use this information. So what you have to do first of all is CRA has done an assessment, and it was $3,100. The liability that the client had recognized in the income tax account was the $2,744 at the top. So you first of all have to put in an adjusting entry to raise the liability for the year to what CRA has assessed. Now this is assuming you agree with the assessment. Of course, you'll look at that and see whether you're going to dispute it or you want to talk to them or whatever. So we put in a credit to the tax liability account, and the debit will go to the income tax account on the P&L. So what we're doing is messing up that account. Remember I said the income tax provision on the P&L should relate only to the income being reported for this particular period. Now you're going to process a bit of an adjustment into the income tax account, and it relates to the prior year. So if it's not very much, which it isn't in this case, $426, it doesn't materially misstate the tax provision that you're showing on the P&L. If it was a large adjustment, then you would have to do some additional work. In your disclosure in the company's financial statements, you would want to split that out as a separate item and say some previous year's income tax liability has been reassessed. So you wouldn't just lump that in the income tax provision account. You would want to split it out so you're disclosing that there was an adjustment related to the prior year, and then you'll have a clean income tax provision for the current year. So we set up that additional liability, and then we indicate that the CRA applied the credit from the GST account. Remember when you looked at the CRA records, they grabbed some money from the GST account and moved it over to clear off the income tax liability. So you want that amount recorded in the client's books. It hasn't been. Remember, CRA did this. The client wasn't aware of it. So as the bookkeeper or accountant, you're going to record that. So you will have to credit the GST liability account. So that changes your view of how much GST you owe, and you will debit the income tax liability account, and that offsets the 426 increased assessment that we recorded in entry number 2. So when you go down the column, you'll see at the bottom we still have the $808.70. And when you looked at that, you noticed that that was a GST refund, and it was booked to the income tax account. So we're going to take care of that in the next slide. So we just book another entry to transfer that $808 to the GST account. So it will be, well, let me see, the refund was the credit. So we'll debit the income tax liability account. You can see you really have to work through these, understand exactly what it is you're dealing with, and get the entries right. So you'll debit the tax liability account and credit the GST account. And once you've done all these entries, you've understood everything, you've balanced everything to CRA records, magically you come up with a zero balance. And someone moving the cursor, it's not me, is noting that on the screen. Thank you. So you've got a final assessment from CRA. You've processed it through the client's books, matched what's going on in the client's books to CRA books, and you've nicely brought this tax year to a zero balance. So I would then, in the next year, I would not even bring the 2016 tax year forward in my analysis. Been assessed, been paid, it's been cleared off. So as an accountant, you're satisfied that that tax year can be tied up in a nice package with a ribbon on it and put aside. CRA can always come back and reassess, but as far as we're concerned at this point, the tax year is clean. So going on to the next slide. Simply calculate the tax provision relating to the current year's income. It turned out to be $9,800 in this case. So we just debit the income tax expense, if you want to call it that, provision on the P&L and credit the tax liability account. And you record that in the 2017 year column, and that will be your carry forward number for the following year. So you end up, you started with a liability on the very extreme right-hand column of $1,050. You have made all your adjustments to the account, including setting up the tax year provision for the current year. So you end up with a tax liability of a little over $10,000. And everything's cleaned up. You go home and you sleep pretty happy that night because you dealt with what can be a complicated account. Excuse me. So going on, that wraps it up. If there are any questions, you can put them in the chat box. Just want to point out a couple of final matters. The better you can be at identifying the type of transaction with Revenue Canada. So it could be income tax, could be GST, could be payroll. Those are the common ones. So if you can identify that and put it in the right account, you can see in this case, the client had mixed up GST and income tax. So get those in the proper boxes. And if it's income tax, record the tax period, the tax year that it relates to. If an accountant sees those two pieces of information, it makes life way easier. So read the assessment notices, read the correspondence. CRA will always tell you what it is they're doing, but I think some people just see the logos and it's CRA, so I'll just put it into the income tax account. So with those tips, you will find you'll make life a lot easier.
I'd like to chime in with just one more very important thing that we haven't really touched upon. Every P&L should have an expense for non-deductible expenses. Parking tickets, for instance, are not deductible. Also, interest and penalties paid on arrears tax is not deductible. Mm-hmm. So it should not go into interest expense as a deduction. It should go into a non-deductible, clearly identified non-deductible account. I don't know, Bob, did you have anything to add about the interest and penalties that can be faced?
No, I don't
Okay.
think so. An accountant will quite often ask you about the interest expense account, and that's one of the reasons they will. They want to make sure you're not expensing something in there that is not expensible according to CRA. The other thing, you probably already know this or you've picked up on it, but this is an extremely complex area.
And this is a relatively simple example.
Yes, but it does cover a lot of the issues that you will face.
I'd like to address, Nicole had a question about the U.S. Now, in the U.S., it can get even trickier because depending on the business, every state, every county, every municipality can levy a sales tax. And for instance, I'm dealing with one client who has over 24 different sales tax rates in 2 states, Pennsylvania and California. So that can be a lot trickier with regards to keeping these properly tracked. So that's something that you definitely have to be a lot more aware of and pay attention to when you're working on U.S. books. The income tax, payroll tax are largely similar, but the sales tax can be far more complex. And if you're doing business across several states, keep in mind that every state is technically sovereign. So every state can have slightly different rules, like different tax accounts, and it can be really, really tricky. And with a high degree of regulation, depending on the industry, there might even be special taxes for you. I just wanted to address that because we have started a bit with the U.S. and it definitely is significantly more complex than Canada when it comes to sales tax.
Perfect. Thank you. Now, what about her other question with regards to the fees and entry making adjusting each time? I know if there's any like CRA penalties and interest, for example, I go ahead, as Bob said, I actually do create a separate account and I actually call it CRA penalties and interest. So that way, when you're looking through, you can see it. Now, with that, if I see something years ago, I used to do an adjusting entry each time. Now I just do an annual adjusting entry so that your balance matches, and then just make a note that includes any interest and penalties for the full year. Is that acceptable as well?
That's the way I would address it as well.
Okay.
I mean, you want to keep the accounts as up to date for your clients as possible. That'll get you as close to real-time reporting as you can be. But more importantly, if they're incurring fees and interest and penalties, you want to encourage them to get that taken care of.
Absolutely.
And then there was one more question, Karen. The $9,800, does it include a free reserve amount? It actually is an estimate. So when we actually get the assessment, a portion of that may become free reserve. But at the time of the estimate, it's just our estimate of what the taxes payable will be.
Yeah, one thing I always like to round it just to show, like if you put it in as $9,819.26, it implies precision that you haven't actually done likely. You haven't calculated. You don't know the taxes to that precise a number. So I usually put some zeros at the end to indicate that it isn't, and to remind me. The one thing you will know is that that's not going to be the final tax number. So any difference will flow into the free reserve account.
So are there any further questions or concerns? Give it a minute. People are typing. This is great. There's not a lot of questions, so I'm assuming that we're going to get perfect tax accounts from Bookkeepers moving forward.
Yes.
Well, it was very informative. It's always nice to see how you do things. And that's why I love collaborating with you guys because, again, it helps me to do my job better, which helps you to do your job better, which, again, helps the clients because I learn from all of these,
Well, not only that. you doing that and providing us cleaner records means we spend less time on the tax return, and it's more likely to come in at a lower cost for the client.
Right, exactly. All right, well, I think it looks like about it for the questions.
Okay.
Yeah, that was a very, very informative today, guys. Thank you.
Thank you.
Thanks. Yeah, it's one of the more interesting and challenging. If you don't have time pressures, it can be a bit of fun to balance things up and make it consistent and show the right picture between CRA, what the client has done, and so on. So, but sometimes it can be extremely frustrating too.
Yes. Yes.
Okay.
All right.
Well, thanks, Tanya. Thank you again for hosting.
Oh, thank you again for being so awesome and providing this information for us to help us all be better at what we do.
All right.
Okay, great. Well,
We're thinking of talking about inventory for next month, so everybody should tune in for that.
oh, absolutely. No, that sounds great. And I will have the recording out to everybody at some point later this afternoon or this evening. I do have to run out for a little bit, so it might not be until early evening. But you'll see that recording out later today.
Excellent.
All right. Well,
Thanks,
thanks
Tanya.
so much. Okay. Take care. Have a great day, everyone.
Bye.
Bye.
Bye.